Hello, and welcome to this next episode of the Money Academy, where we help you make smarter decisions with respect to your own personal finances. In today's episode, I'm going to rewind a few weeks and revisit an area that I spoke about a couple of weeks ago in an earlier episode of the podcast. And it's with respect to what I termed to be the quiet robbery. Now, for those of you that perhaps watched the episode or maybe you didn't catch it at all, I'll give you a bit of a recap. First of all, there is a lot in the world of money that doesn't really appear to make sense right now. We've got situations where inflation feels like it's running high, the value of the money in your pocket feels like it's diminishing at an ever alarming rate of knots. And in that episode, we unpacked why, from my perspective, based off my own analysis, I thought that it was happening. To summarize and recap that position for you today, for many years, we have been very fortunate as a society where the cost of money has been relatively cheap. If you go back 25 years, maybe even slightly more, you will see a trend where interest rates come down. You'll also see a trend where borrowing goes up. Let's not split hairs today about why that did or didn't happen. But look, we loaded up for years and years on cheap debt. That situation exasperated itself in 2008 in and around the banking crisis, and it absolutely turbocharged it in and around the COVID pandemic when we were essentially throwing money at just about every problem that emerged. We were paying people to stay at home. We were funding and subsidizing other schemes to keep the economy moving, and it cost us a fortune. Overlay on top of that, whilst this money was historically cheap, we also had a situation where we were running structural deficits. In other words, not only was the money really, really cheap for significant periods of time, and most years actually, we were simply spending more than we earned. In some respects, that didn't matter too much with respect to our day-to-day finances as a public body because we could afford to service the debt. Let's just disregard a moment the whole debasement issue with respect to, and we're seeing this playing out a lot, particularly in the United States at the moment, whereby debts are getting more and more, and we are essentially refinancing that debt in different ways, in addition to printing and creating and injecting more money into the system, which, yes, it pays the bill, but it devalues the money in your pocket. On a practical level, what that means is you're competing against two distinctly different factors. Number one, inflation. How much the cost of your goods and services are going up by every year. The second one, how much in value is the pound or the dollar in my pocket decreasing? So what you start to see is, yes, prices go up, but value goes down, and that gap becomes wider and wider. And if you listen to that podcast or you read the articles that I accompanied it with, you'd perhaps be forgiven for thinking it was a little bit all doom and gloom. And I reflected on that for a little while and thought, what we need to do now is circle back, because we touched on perhaps what I consider to be some solutions for this particular problem in the podcast and in the articles, but I wanted to perhaps unpack those in a little bit more detail for you. Before I do that, I think it's perhaps worth just taking a brief moment to explain one thing, and that's that when we're talking about government structural deficits and all that other kind of stuff, interest rates, whatever it is, we would be forgiven for feeling uh, quite small and meaningless entities that this state enterprise is operating over here in isolation, and we, the little people, are having this done to us. Um, and I kind of subscribe to that, if I'm really honest with you. You know, when you've got governments talking about trillions of pounds or trillions of dollars of debt, you know, if you liquidated every penny that Elon Musk was worth and Jeff Bezos, for example, you still wouldn't come close to touching the structural deficit in the UK, you'd still probably be about 50% of the money borrowed that's owed. So we're talking about huge sums of money. And the reality is that in order to actually fix that problem from a bigger picture perspective, we need to see significant changes in how government and government funding operates. What I mean by that in reality, we need to see either huge reductions in public spending, a kind that is realistically unprecedented, because you not only have to balance the spending today, you've got to get beneath the level of spending, i.e., for many years we have spent more than we have earned. We've now got to spend persistently less than we have earned, and we've got to spend less at such a level that we can actually start to make a meaningful reduction in the deficit, noting that the interest costs alone on UK government debt are more than the combined spending in a number of government departments in totality, including industries or departments rather like defence, which when you're talking about a organisation that takes tens of billions of pounds a year in government funding, you can quickly start to see the scale of the problem. The impact of making those kind of cuts, of course, is that it gets really difficult to sustain them in a way that is palatable for the taxpayer and also doesn't unintentionally cause things like recession in the economy. It's a real balance. On the other hand, you've also got to consider, can we grow our way out of this problem? And that would require a significant increase in GDP, our gross domestic product, the value of our economy, if you like. Now, as a UK, we certainly in the modern era are a very services based economy. And that means that there are lots of people who perhaps profit and do very well individually from the provision of services in exchange for a fee. But what that means is if you think about the economy as a pie, and the services economy cuts up the pie nicely, and there are bigger pieces for some and there are smaller pieces for others. But what it doesn't really do that well compared to economies that are based around manufacturing, exports, all that other kind of stuff, is it doesn't make the pie any bigger. And the problem we have right now is that this money pie is not big enough to give everybody a piece and pay down the debt. We need a bigger pie. How do you do that on a way that would have to scale your economy multiple times over to generate the kind of income that you need? That's the big picture stuff. Let's park that for today. We've talked about the macro conditions, we've talked about the big picture considerations. What I really want to talk about today is how you as an individual can perhaps prepare yourself for the changing economic circumstances that you might find yourself in. And to do that, I've broken it down really into three core areas. So these are, again, we've spoken about the big picture stuff. These are the practical steps that you as an individual can take. I categorically recognize that it's very easy for me to sit here and say these things. It's sometimes far harder for you as individuals to go and do them. Let's not take that away. But the message I need to give you is really clear. Nobody is going to be some kind of cavalry that comes over the hill and saves you. If you wait for somebody else to come along and solve the problem while you sit admiring it, you're going to be left behind. And these things are going to start happening to you, and your ability to react, your ability to plan, and your ability to do things about it becomes much, much more difficult. Okay. So, what I'm going to talk about now might mean slightly different things to different people. You might be able to do some, you might be able to do all, you might be able to do none, you might be able to bit and batter it. But these are what I think are the three things you need to do to prepare yourself for the changing economic circumstances that we're going to face. And the first one is to build what I call your own margin of safety. In reality, this is perhaps the most basic of the three things that I want to talk about to you today. And in reality, this is just going to require you to do your own financial health check, first of all. figure out on a very basic level, what is your income versus what is your expenditure? Map it out. Hopefully, you'll be in a situation whereby there is at least the same coming in as there is going out. Or maybe, and this is really where we want to be for most people, in fact, this is where we want to be for everybody, you want to be in a situation where there is more coming in than there is going out. In other words, you are running your own personal budget surplus. If you are in a situation where that's in the minuses and there's actually more going out than there is coming in every month, that's a perhaps very different conversation that we need to have. And there's other material out there to help you with that. But I'm really looking at people who are there or thereabouts breaking even, or maybe have a slight bit of buffer today. And and for those people, not only do you want to understand your expenditure, you also need to think about what that expenditure consists of. And what I would say to you today with respect to increasing your margin of safety is this. And I'm going to make some figures up now. This is not representative of the average person or what I think is a good income or not. I'm just going to throw some figures out for example's sake. If your income net after costs and taxes, combined household income is £4,000 a year, and your forecasted expenses, when you include things like mortgages or rent, council tax, utilities, shopping, car insurance, whatever it is, hopefully with a little bit of something left over for your social spending in that budget, let's say it accounts for 3,800 of the £4,000. You've got £200 as a buffer. My first question to you, what can you do to put a little bit more headroom in that budget? In other words, right now, you've got realistically less than 10% buffer in your budget. I'm not saying 10% is the golden number, but certainly I would be aiming for a minimum of 10% buffer between income and expenditure. That might mean that you have to cut some of your expenses, and that might be quite emotive for people. But the reality is, think back to Awful April this year. It truly looked to its name. It was absolutely bloody awful, quite frankly, and it felt like everything was rising exponentially, and people's budgets were just being eaten away. Right? Ask yourself this: um, come next April, when it's probably just as awful, if not more, than it was last year, and bills are going up 5, 10, 20% or more, depending on whatever it is that you've got. How is that budget going to grow, and how are you going to absorb that cost? If you've not got much of a buffer, you need to put more in there. Now, that doesn't mean that you need to go and live in some kind of religious cult lifestyle, living on beans and rice and only putting the heating on between 6 and 1/2 past every second day. I am not saying that. You need to be sensible, and what you're going to do needs to be realistic. My question to you is, first of all, where can you take the easy wins? So, for example, are you paying too much for certain bills? Are you paying for subscriptions, for example, that you just know you're not using? Are you on a mobile phone contract out of contract tariff? Those things straight away. Most people have at least one subscription that they just don't even know what it is, or don't use. That's a marginal gain. But hey, let's cancel it. Let's take the time to cancel it. If you're on an out of contract tariff, you are probably paying considerably more than you should compared to if you switched to a SIM only deal. Again, that might be a saving anywhere. And I did this for us at home a couple of years ago. I think we saved about £40, £50 a month, if I remember rightly, just by taking us from the out of contract tariff and changing it to a SIM only with the exact same data and call plan. In totality, about a £50 a month saving. That's really significant. That's what, £600 a year? For no additional work, for no change to lifestyle, but we found the saving. Likewise, get rid of the subscriptions that you don't use. The final thing I would say with respect to that is, are you double covered for things? And what I mean by that is, if you have, for example, a paid bank account and it provides things like travel insurance, it provides things like breakdown cover, are those products that you're already paying for through the function of your bank account sufficient for your needs, or do you need that additional cover? Take the time to interrogate what you're actually getting relative to what you're paying for. You might find that you can make some savings. And do you know what? If you can save £10 here, £30 there, £20 there, all of a sudden these savings add up. And you might find that actually you're probably saving about £100 a month in most cases. I would challenge you to do that. It's a bit sad, but I find it quite fun. See what you can save. You might find that in some cases you're looking at three figures a month in savings. Straight away, you have put that buffer in there without having to do anything else or make any actual lifestyle sacrifice. And then you can start to have a genuine conversation about, well, do we need to cut more, or is what we've done sufficient? So that's the first one. Build your margin of safety. Next, perhaps a bit more of a challenging one for some people, is we need to think about our income. And I can feel when I say to people, up your income, you're sat there doing whatever you're doing, driving to work, commuting, working out in the gym, whatever, rolling your eyes thinking, here we go, another one talking about just up your income, just earn more. Sounds really simple, mate. Yeah, cheers. And I get it because I've heard it, I've read it. There isn't a podcaster, YouTuber, writer out there that doesn't just chuck it out there as some throwaway line. It's infuriating. Yeah, just earn more. Thanks. But look, hear me out a moment. In a world where your money gets worth considerably less or worth considerably less every year, how can you legitimately sustain or even improve your own standard of living without finding a way to earn more? And I offer that to you as a bit of a rhetorical question because there comes a point where you can only cut so much. Cutting isn't necessarily going to make a material difference to you in terms of improving your lifestyle. It's realistically a lifestyle preservation tool. But you can only cut so far before you start to eat away at the lifestyle that you've worked so hard to build and are trying to preserve. There will come a point where you have to think about finding a way to increase your income. And again, I've broken this down into three different ways. And again, hear me out. Some of them might work for you. Great. All of them might. They might not. But I've tried to do this in a way that I think is reasonable and sensible and is grounded at the average person who can take this as a practical, actionable measure in a as a means to improving their life rather than just another bloke pontificating from on high about how you should earn more money. And first of all, again, sounds really patronizing, sounds really simple, but is without doubt the biggest leveraged thing that you can do because it will typically require one conversation or more and no more effort besides. And that's if you're in employment, can you negotiate a pay rise? It sounds simple. It's relatively low sacrifice once you've had that conversation that, let's be honest, no one wants to take their boss to one side and ask for a pay rise. There are ways to do it, and I think you need to be very sensible and you need to be very conscientious around how you might choose to do that. And there will be people sat listening to this who will recognize the conditions that they are working in terms of their business conditions. Maybe they're publicly employed, and that's not necessarily feasible for some, and I recognize that. But if you are able to have those conversations and you approach it from a mature perspective that demonstrates that you are a conscientious employee that is looking to add value to the business, that I want to stay here, but in order to do that, I need to think about how I'm compensated. And actually, there's a gap between what I'm earning and inflation, or what I'm earning and what people are paying comparatively elsewhere. I'd like to have a meaningful and sensible conversation with you about that. Most people are generally inclined to listen. They might not be able to meet your demands, but at least you've had the opportunity to ask. And if you don't ask, you don't get. You might be pleasantly surprised. Again, I completely recognize that there will be people that cannot negotiate pay because of the organization that they work for and the structures that they're in. But if you can, you should absolutely think about whether that's something that you want to do. After that, number two, that is in reality a straight time for money swap. So these are things that typically don't scale all that well. but they are that second job, that side hustle that you can come away from your primary job at and you can put some time to in order to generate relatively quick and easy cash flow. Great example, pizza delivery round or something similar. Um, I recognize as much as anybody that the last thing people want to do is go and do the 9 to 5 or whatever, excuse me, or whatever shift it is that they're doing, and then come home, do whatever it is that they've got to do, and somewhere in that really busy schedule, go and try and do a delivery round or something on top of that. I would even go as far as to suggest that very few, if anybody, wants to actually go and do that. And I'm not suggesting that this is a social choice, but for some people out there, it might be one of necessity. And if it's one of necessity and you're sat there watching Netflix or whatever it is that you're doing, worrying about how you're going to get enough money coming in next month to feed the kids or whatever it is, guys, we need to have a conversation about putting down and have a serious think about putting down Netflix, stopping doing whatever it is, and getting out there and earning some more cash. The gig economy, the casual economy typically presents lots of opportunities. I'm not suggesting that it is something that is available to everyone. Again, I'm not suggesting that there is a one size fits all, but a very quick Google, you'll be able to find those opportunities that are in your area. And when you get into that routine and you start doing them, you will start to notice the cash flow. And that might be the difference between making ends meet next month or not. That's a personal choice because there is a sacrifice there. And that sacrifice might be 3, 4 hours, 2, 3 times a week, or whatever it is, in order to not be at home, to not be doing those things that that I would choose to do, in order to go out and do something else. But you need to have a real think about whether that's a decision that you have to make. And if it's one of financial necessity, I would suggest that that's probably a serious consideration and a serious conversation to have at home. The positive side to this, however, is that the cash flow is relatively quick. Some jobs pay weekly, some jobs pay monthly. But the reality is, once you've done a few shifts, you're going to start to see a very meaningful contribution towards the household finances. Clearly, there are tax considerations, and you need to weigh up whether that's something that's going to work for you. But let's go back to that analogy of the pizza delivery round, and I get paid weekly. Well, I do 3 shifts, following week, I get paid. I can straight away start to see the benefit of that, right? The benefits are quickly felt. Difficult to scale, I grant you. There are no amount of pizzas you can deliver 3 nights a week that will make you into a multimillionaire unless you're doing some other kind of scheme with it. But a straight time for cash swap is a genuinely, really meaningful way that people can make a significant difference to their household finances. Third one, and this is a little bit more quirky and a little bit more niche, and it's definitely something that doesn't necessarily appeal to everybody because it requires a lot of investment of your own time. And typically, that investment is not something that is reaped, the benefits of it rather aren't reaped up front. This is a kind of a downstream intervention. And that's to identify and build skills or a business that you can monetize. Now, I said earlier, if you're going to take the time to learn skills that people are willing to pay for, that's great. If you have identified a niche and you want to build a small business and go into that as something that either you do on the side or something that might one day take over and become your primary source of income, that's fantastic. And I would applaud you for doing that. But it is not going to pay your mortgage overnight. In very, very, very few instances, do these things become profitable quickly. If you're learning skills or you're starting up a business, it can typically take months or even longer before you start to see a meaningful income generated from that. And so if you're somebody that is out looking for quick cash, this is probably not the thing for you. You need to perhaps think about how you do that straight time for money swap to make sure that the bills are paid. However, if you are someone that recognizes that they need to up their income, maybe I can get a pay rise, maybe I can't, but I'm thinking about, hey, how do I longer term build something that can potentially really scale? It's going to come through either skills or through your own business. Okay. And everywhere, no matter where you live, there is a demand for skills. There is a demand for people to come along and solve problems for somebody. So if you can take the time to identify what those skills are that are in demand, because they will be different everywhere in the world, even in the same country, in the UK, there are skills that will be really, really valuable in the Scottish Highlands that would probably be less valuable if I lived in Colchester, and vice versa. Equally, there are some skills that you can apply anywhere. Take the time to understand that, to learn skills that are of genuine value to the area that you're living or to the service that you're choosing to provide, and invest in that and scale it. That's where you're going to see the really big and meaningful gains with respect to your income, but it takes time and there's no overnight fix. So that's the second one. So we've margin of safety. Can you find some buffer in the budget? Second one, what can we do about building the income? And the third and final one is, and again, really simple to sit here and say, sometimes far harder to do, and that's to buy appreciating assets. Um, Reality is that, again, we spoke about the building a margin of safety as a bit of a preservation method. There are only realistically two ways to grow your lifestyle, and that is through income, and that is through a well-placed investment. Now, if you are someone that is a particularly skilled investor and you can go out and you can identify and you can buy appreciating assets, you might not even need to have that income conversation or think about how you're going to scale your income, because when done properly, this can really scale for you in a way that other things just can't. But what you need to be able to do is to commit that money for for A, at sufficient scale so that you can generate meaningful returns, and B, for a sufficient period of time so that you can actually realize the benefits of that investment. And clearly, investment in this case is anything that we think is going to appreciate in value over time. That might be stocks, that might be cryptocurrency, that might be fine wine, whiskey, real estate, or whatever it is. I'm not here today to sit and tell you about what you should or shouldn't be investing in. What you choose to invest in might be very different to what I choose to invest in, but that's a very personal decision. And that's based off our own understanding, our own competence, our own levels of risk tolerance, and what's available to us to deploy as cash today, right? Um, so rather than lampoon you about whether you should buy this stock, whether you should buy that token, whether you should not do whatever, I'm going to avoid categories of investment. Do your own research, figure out what works for you. I personally am a big fan of stocks and cryptocurrency. I also recognize that that category does not work for everybody. But what I wanted to do, instead of tell you what to invest in, I'm going to offer you three broader thoughts with respect to investment, because I think we all recognize that a well placed investment in something can be genuinely life changing. But there are also a lot of pitfalls that people fall into, and that's what these three are today. First one, understand what you are getting into. Clearly, what you could do is trundle off down the high street wherever you live and hire an investment advisor, or virtually hire an investment advisor, and they could take care of all of this for you, right? For the most part, however, most people are not going to do that because either don't have the net worth or they're not comfortable doing it. And therefore, if you're going to make your own investment decisions, you need to be comfortable, even if only in the most simple and basic terms, in understanding how your investment works. Now, let's just use an example of a stock. I am not suggesting that that means that you should develop the skills that are required to go and take over and be the CEO of somebody like McDonald's or whoever it is. But what I need you to understand is that what we're talking about here is, can you, in very simple terms, recognize how does the business generate income? How does that reflect in appreciation of the stock price? What are the risks? All that kind of stuff. Apply those questions, broadly speaking, to any investment asset or investment category. And my rule of thumb here is that if you can't explain those things in simple, basic and plain English to somebody, it's possibly too complicated for you to get involved in. That does not make it a bad investment. But if you don't understand what you're getting into, there's a very realistic possibility that you're going to make the wrong decision at the wrong time and ultimately make a loss. Understand what you're getting into with respect to your investment. The next point I would say with respect to investing, and it kind of follows on from that really, is to make sure that things like your time horizon, your investment itself, and your risk tolerance are all correlated. Before getting into any investment, it's really important to think about what you should realistically expect to achieve from it. And not only that, but also within what time frame and how much volatility you should expect to endure on that price. For example, I personally would not touch real estate with a barge pole, but I recognize that a lot of people like it and choose to do it. When you buy property, the valuation doesn't necessarily change that much on a day-to-day basis. It would take months or even years for someone to come and revalue that property potentially before you saw a change in price. You go and buy a stock, however, and most of the time, 5 days a week, it's trading on a chart going up and down. And therefore, your expectations need to be different. Your risk tolerance for volatility, excuse me, needs to be different. Equally, I cannot necessarily expect absolute life-changing gains on an investment that's going to, make several multiples of my money, and it's going to make it very, very quickly. And not expect volatility to come with that, because let's be honest, typically volatility is the price we pay for extreme reward. But also, I can't necessarily expect to generate that return from an older style, tried and tested investment, i.e., going and buying a blue chip stock that's been around forever and a day and is doing the exact same thing today as it was 50 years ago, doesn't mean it's not a bad company. Sorry, it doesn't mean it's not a good company, and it doesn't mean it's not doing well. Or I go and buy a buy to let in my local town. Again, it doesn't mean it's not a bad investment and doesn't mean it's not doing well. It just means that it's probably not the right investment to achieve what it is that I'm trying to achieve here. And I can't have this without going and finding something that is out of the risk curve, that is perhaps something that people haven't seen, haven't considered, haven't thought about, or certainly comes with a level of volatility that most people are not prepared to expect. Equally, if you're interested in perhaps more slower and sustained growth, some of those things that I spoke about at the beginning might be something that is more in keeping with what you want, and therefore a small cap stock or a meme token or whatever it is equally not going to give you what you're looking for there. So make sure that you understand what you're getting into, and make sure that your expectations and time horizon and your risk tolerance all match, because the last thing of the particular investment that you've made and sell it because it's dropped 30% in order to cut your losses, when actually that could be completely normal behavior for that particular asset. And the final one goes without saying, but the amount of times this catches people out is unbelievable. And that's, if it sounds too good to be true, it probably is. Guys, we've seen it all before. We all know somebody that has been approached by a scam. We maybe have been victims of scams, or people that are close to us have been victims of scams ourselves. And they all present in a very similar way. Granted, with varying levels of sophistication, but broadly speaking, there is a pattern to them. I am not suggesting that every investment opportunity that is out there is a scam for those people that are perhaps a little bit more investment shy. But I think the things that I would look for are something like this. And I'm going to read you now a paraphrase of an example that I actually genuinely encountered recently. It was a friend who was looking to invest. He brought it to my attention, said, "Hey, what do you think? Tell me what you think when I read this to you." And again, I'm summarizing here, and I'm trying to do it in a way that doesn't necessarily name people for obvious reasons. But hey, have you got £100,000 to invest? Do you want to make an 8 to 10% annual return a year, index linked? Is it 8 to 10%, or is it index linked? discuss, with essentially no costs to you or any real risks to your investment. That to me sounds like a fantastic opportunity, right? But has anybody legitimately found an investment opportunity that doesn't come with some kind of risk? You buy an index fund in the stock market, there is a volatility risk. You buy a rental property, there is a risk that you're either not going to get a tenant or the tenant's going to trash it or it's going to get struck by lightning or whatever it is. There is always a risk associated to investment. And again, you could map 1,000 investments and we could all talk about what those associated risks are. But there is no such thing that I found in any legitimate investment opportunity that is risk free. Equally, the other thing I would suggest to you with an investment opportunity is that there is no such thing as a guaranteed return. Now, I need to caveat that a moment because I think it's very important that I make myself clear. Clearly, you can lock yourself into contracted returns on your money. So, for example, I could buy a property, I could put a tenant in it, and I could contract that the rent will be at a certain price for a certain period of time. That is a contracted return. In terms of cash flow, that is not the same as an investment return. The investment return is the total value of the property over a period of time. Likewise, I can buy a stock and I can be guaranteed a dividend in year. That is not the same as being guaranteed a return on the stock in the future. Think very carefully that those two things are not the same. There is no such thing as no risk. There is no such thing as a guaranteed return with no volatility attached to it. And there is usually a sense of urgency to act. We've got to get in before it's all gone, before somebody else buys it, whatever it is. We're creating a sense of urgency because we want you to jump in there thinking that this once in a lifetime opportunity is going to pass you by if you don't act quickly. So there's the three things. I could go on, but broadly speaking, you need to understand what you're getting into. Make sure that everything matches your expectations and your risk tolerance, and make sure it doesn't sound too good to be true. Because if it sounds too good to be true, it probably is. Ultimately, regardless of which of those three things that you're going after, building your margin of safety, upping your income, investing in appreciating assets, or maybe a combination of all three, ultimately it's there as a practical measure that you can take to help you control the things that are within your gift of control, to protect what you have, and to make sure that you can continue to build, buffer, and maybe even enhance your standard of living in an economy that is, quite frankly, at the moment, working against ordinary people like you. Hope you enjoyed the episode, and thank you for getting to the end and listening to everything that I've got to say. If you enjoyed it, please recommend us to people that might also benefit from the opportunity to get the information that they need to make better financial decisions for yourself. Like, subscribe, follow, and pass it on to your friends. Thanks very much for following. Take care, and I look forward to catching up with you in the next episode.